So on Monday we got through, I guess most of, not quite, about 2/3 of Chapter 8 regarding earned income credit. And just as review, there's a total of 15 rules for claiming earned income credit. The first 7 rules apply to everybody. There are 3 rules to, if you have a qualifying child. There's going to be 4 more rules if you don't have a qualifying child, and then 1 more rule that applies to everybody. So our first rule was your adjusted gross income has to be under one of these thresholds depending on your filing status and how many qualifying children you have. Our second rule was you have to have a valid Social Security number by the due date of your return. And if you're married, your spouse must also have a valid Social Security number if you're married filing joint. You must meet certain requirements if you are separated from your spouse and not filing a joint return, which means either you've qualified to file as head of household, or special rules for married filing separately starting in 2021, actually. Brand new rules. All this says is you lived apart for the last 6 months of the year. So you and your spouse did not live together anytime during the last 6 months of the year. Even if you end up having to file married filing separately, because remember, head of household requires that you also pay more than half the cost of keeping up your home. So married filing separately can now claim earned income credit. And that's brand new in 2021. So just a heads up in case you end up doing any previous year's tax returns, 2020 and before, if you're married filing separately, you just don't get earned income credit, period.
And that's 2021?
Yeah, 2021 is when they brought in this new rule where you could be married filing separate and still get earned income credit. Okay, rule number 4 is you must be a U.S. citizen or resident alien for the whole year. So we did have examples. I have had clients where they changed their status from non-resident to resident partway through the year. But most of our clients, I would say 99% or more of our clients are U.S. citizens or resident aliens, so we don't have to worry about that. We had this rule, we probably talked more about this than it was worth, but if you work and live in a foreign country, you can exclude some of your income from tax for income tax purposes, but if you exclude that income and you end up not paying U.S. tax on it, you file Form 2555, but then on the flip side, you don't get to claim any earned income credit. So it may be worthwhile to claim that income and pay tax on it in order to get the earned income credit. Number 6, your investment income, that's interest, dividends, capital gains, net real estate income. That total must be less than $10,300. And finally, you must have earned income. That's why they call it the earned income credit. Okay, so those are rules for everybody. Chapter 2, rules if you have a qualifying child. Well, these are chapters, like this is from a book that the IRS publishes. So the IRS booklet on earned income credit is 4 chapters. So these are the rules if you have a qualifying child. And the qualifying child have the same rules as for claiming dependents, relationship, age, residency, and joint return tests. Notice that support is missing.
Is this guy expected today?
No, I don't think so. Okay. So we talked a little bit about that, where you could technically claim someone for earned income credit, even though they're not your dependent because of the support test. And we talked about whether that could be the case because of the children getting their own Social Security income, so they technically do support themselves, or something like that. Qualifying child can't be used by more than one person to claim the earned income credit. So this is should seem fairly obvious. Let's see, also missing from here, not mentioned, is the tiebreaker test. And let's see, tiebreaker test says that parents are first. Two, there's specific rules about two parents. And third was the AGI rule. Okay, so what those tiebreaker test rules are is if a parent and someone else qualify to claim a child because they meet all of these other four tests for the same child, then the parent has the first option always to claim that child. The two parents rule said that if two parents both qualify to claim a child for earned income credit, then they can decide between them which parent should claim the child. But if they don't agree, can't decide, or they both try to claim the child, then we'll go first to number of nights, and then if that's still the same, then it's the higher AGI between the two parents. And then third, the AGI rule says that there's like two different sections. One is if the parent could claim the child but decides not to, someone else can only claim that child if their AGI is higher than the parent's AGI. And secondly, if there are no parents involved in this so-called tie, then only the person with the highest adjusted gross income can claim any of the children. Okay, and then our third rule for if you have a qualifying child is you cannot be the qualifying child of another person. This is just like, very similar to someone who is a dependent can't claim any dependents. And this one says qualifying child, we're specifically talking about qualifying child for EIC purposes, which means that you might not be someone's dependent because of the support test, but if you could be their qualifying child because of the other four tests, and they could claim you for earned income credit purposes, then you can't claim any qualifying children of your own for earned income credit purposes. Okay, so that's all what we covered on Monday. Do you have any questions? Okay, so this part we're going to breeze through is fairly uncommon. I think the slides kind of drag it out more than necessary, so we'll just go off of this chart for the rest of this chapter. So if you do not have a qualifying child, then you have to meet these four rules. So first, you must meet the age requirements. So not everybody who works and doesn't have qualifying children would qualify for the EIC. You must be at least 25 and under 65. So that means any age from 25 to 64, you can claim that you can qualify for the earned income credit. And you can't be the dependent of another person, you can't be the qualifying child of another person. And why do they have these two different rules? They seem to say the same thing, but remember, when we're talking about qualifying child in this context, we're talking about qualifying child for the earned income credit, not for dependency. So relationship, age, residency, and joint return, somebody could claim you as a qualifying child for earned income credit without claiming you as a dependent, technically, although that's pretty rare. And you must have lived in the United States for more than half the year. Okay. That's actually not new. Remember when we talked about the residency test, The residency test was slightly different than the normal residency test. This residency test said that you and your children must live in the United States for more than half the year. So really this applies to everybody, although it's listed as a separate rule under not having a qualifying child. Okay, so once you've passed all of these tests, then you can finally go and figure out and claim your earned income credit. So your earned income credit is going to be based on your earned income, and it's also going to be based on your adjusted gross income. So you have earned income and adjusted gross income. And the way that's going to work, I'll put up a chart in just a moment that'll help understand that, help us understand that. But your earned income must be less than, the same thresholds that we had for adjusted gross income. And then you would look up your earned income credit or your earned income in a table, and then in some cases you might also look up your adjusted gross income in a table and figure out your earned income credit based on that. Okay, so any questions about the rules if you don't have a qualifying child? All right, let's go into computing our earned income credit. Okay, so here's a chart. This one I did in Excel, or not Excel, but OpenOffice. And here's another chart that was created by the Tax Foundation. This chart was based on 2019 figures, so the numbers are slightly different, but the shape is always the same. This is what the shape of the earned income credit chart looks like. So down here, if you have zero income, you have zero earned income credit. And the more income you earn, the more earned income credit you get. So if you have no children, it actually goes up at a pretty slow rate. This is actually around, this is 7.65% of your income up to this, where the plateau starts. And this goes up at a rate of 34%, and this goes up at a rate of 40% of your earned income, and this goes up at a rate of 45% of your earned income. Until you reach one of these plateaus. So for a while, these plateaus are about, well, the dotted lines are for single head of household and married filing separately. So the dotted lines, the plateaus are anywhere from $5,000 to $8,000 each. And then the married plateau is an extra around $6,000 more than that. Once you reach the end of the plateau, then in this direction, the more earned income you have, the less earned income credit you get. Okay, so this goes down by about 21% of, every extra dollar you make, your earned income credit goes down by 21 cents. And these are both 21%. And this one goes down by about 16%, and this one goes down by 7.65%. Okay, so because of this rule, to figure your earned income credit, you first will look up your earned income in a chart, And we'll show you an example of the chart in just a minute. And then, second, if your AGI is more than earned income, then look up your adjusted gross income. And then third, earned income credit is the smaller from step 1 or step 2. Okay, so for example, let's say I'm head of household, and my earned income, this is the amount of money I make for my job, is $26,000. But my AGI, because I got the permanent fund dividend, this is supposed to be an E, is $1,312, or more than 26,000. So my total AGI is 27,312. So, and I have one qualifying child. Okay, so I'll look up my earned income credit on the chart, and we can't really read it off of this graph, but if we look it up in the chart, my $26,000 earned income is going to result
2,500.
2,791.
So based on the first step, so I look up my earned income and I get 2,791. And the second step, I'm going to look up my total adjusted gross income, 27,312, and I get 2,583. So third step is we're going to pick the smaller of these two, and my earned income credit turns out to be 2,583. So 26,000 is somewhere around like here. And then 27,312 is somewhere like here. So I'm on this slope where it's going down. So that means the more income I have, the less earned income credit I have. Now, one clever idea I could have is if I put $1,312 into a traditional IRA, that's going to reduce my adjusted gross income back down to my earned income, and I'll actually move back up, backwards on this chart to increase my earned income credit. So not only do I get that tax deduction, but I qualify for additional extra earned income credit.
Wait, what's the 1, 2, and 3 that's according to the ones above, how you calculate it differently?
This one is where I've looked up my earned income in a chart. And the second step is where I've looked up my adjusted gross income in a chart. And then 3 is where I've taken the first 2 steps.
Okay, but
So step 1, you look up your earned income.
why is the number 2 at the bottom larger than number 1 if your AGI is higher?
It's not. 2 is smaller.
2583 versus 2791?
Yeah, 2583 is less than 2791.
Oh.
Because we're on,
I see. 2791 first is looking at based on the AGI. Okay, I thought it was...
No, 2791 is where I looked up my earned income. So if I look here at 26,000, it's going to come up to here. So 26,000 earned income results in this 2,791.
Okay.
But because of the extra income I got from the PFD, I'm looking at 27,312. But because this is sloping down, the more income I have, the smaller my earned income credit is. So this is going down from 2,700 down to 2,583.
Okay, gotcha.
Okay, so if I were able to reduce my adjusted gross income somehow, I would move back up this chart. But if your AGI is less than your earned income, you don't have to worry about looking it up twice. Your AGI might be less than your earned income because you put money into an IRA, or you might have other adjustments, such as student loan interest deduction or something else, some other stuff like that. But this is the basic shape of the chart. So don't get too tied up on any of these particular values. Just remember, it goes up for a while, it's flat for a while, and then it goes down for a while. Okay. So in this region, it's an incentive to work. The more money you make, the more earned income credit you get. In this region, it's just maxed out. And in this region, basically the idea is you're now earning enough to, support yourself and your family with less help from the government.
So the people that are in the, oftentimes in the incline and the plateau, it's very likely they might be getting government assistance as well.
Yes.
Does that ever get counted into the calculations?
No, they may. So yes, that's a good point. Is someone who's, for example, below the poverty line or something, they may have government. They may have food stamps and housing assistance and other welfare benefits. But remember from chapter 4, welfare benefits are never treated as income.
So they might be getting their welfare benefits. In addition, they might be getting all their tax deductions and even like a earned income on the back end.
Yeah. So if someone who's in this lower region who's making only about $10,000 a year, they may be getting $800 a month in food stamps. They may be getting rental assistance of another $1,200, and they'll still get earned income credit of up to. Oh, I should mention what these caps are at.
But if they're getting unemployment, then that'd be considered taxable income, right?
Right, unemployment. Unemployment is not a welfare benefit.
But does it count as earned income? I think you mentioned it last week.
It does not count as earned income. So our plateaus here are 3,733 for 2022. Here is 6,164 in 2022, and here is 6,935 in 2022. That may be different than what I said on Monday, because when I was reading off the chart over there, and the desk reference still had 2021 information on it. And for no children, the 2022 maximum EIC was $560. So again, much less generous for people that don't have qualifying children.
People that aren't trying to raise the population.
Yeah.
Bring on the next generation of taxpayers.
I did look up our 2023 tax credit amounts, so this may be more interesting to you because you'll probably be doing 2023 tax returns. 7,430 with 3 or more children. 6,604 for For 2 children, 3,995. With 1 child and with no children, $600. So they did publish, IRS has published those figures. They haven't published the actual chart itself. Okay. Any questions on this screen before I erase it and move on? Okay, so let me just take another note. Let's say my example was head of household, 1 qualifying child, earned income is 26,000, and my AGI is 27,312. Okay, so this is where'd my mouse go? Right, so this is our earned income chart in kind of a web table format instead of in a booklet format. So to figure our earned income, well, these headings say they don't repeat the headings, but the headings say our first set of numbers is for single, head of household, qualifying surviving spouse, and married filing separately if you meet the other qualifications. And the second set of numbers is for married filing jointly. And then it goes 0 children, 1 child, 2 children, 3 children, 0, 1, 2, 3. So if I wanted to look up my earned income credit from the previous example, my earned income is 26,000. So I'm looking for 26,000 way over on the left. Okay, and notice that the number shows up twice. So just like the tax tables, if you are right on the edge of one of these categories, use the second line down. Because what it actually says is if your income is at least this much, but less than this much. So for 26,000 earned income, I wonder if I can squeeze the 27. No. Okay. For 26,000 earned income, I would use this line here. And since I'm head of household, I'll use the first set of numbers with 1 qualifying child. This is my earned income credit of 2,791. And then I have to also look up, because my AGI is higher than my earned income, then we have to look up 27,312, which is this line here, same column, 2,583. And because that was smaller than the other number, that is my earned income credit for the year.
So if someone had rental income, but they didn't have, which doesn't count as investment income, but probably counts as towards their AGI regardless, then they'd probably be looking at that value.
Yeah.
But if they only had rental income, then they wouldn't be able to use the EI.
Right, because your earned income would be 0. Because net rental income is never considered earned income. Okay, so that's how to use these charts, and the charts are again in your third workbook, or your workbook, which is the third book of the tax school books that we gave out at the beginning. And let me jump through these slides to make sure that I didn't miss anything. So there's our age. Okay, so our age limits, we said 25, at least 25, but under 65. If you're married filing jointly, only one of the two spouses have to fit into that age range. So if you're 67 and your spouse is 63, you can still get earned income credit on a married filing joint return. And here's an example of some EIC situations. So here's an example of unmarried parents, the tiebreaker test. So your 5-year-old son Mike and Mike's father, the three of you, live together the whole year. You and Sam are not married. So Mike meets all of the qualifying child tests for both of you. Age, residency, joint return, and relationship. So because of that, you both could qualify to claim Mike as a dependent and for earned income credit, but you can't both claim that benefit. And in this case, it's not divorced or separated parents, so we can't use an 8332 to split up the benefits. So one of you, either you or Mike's father, are going to claim all of the benefits. And it says that your earned income is $12,000 and the father's earned income is $14,000, and neither of you have any other income. So what the tiebreaker test is going to say when there are two parents involved, it's going to ask, well, first of all, do you agree on who should claim the child? So Sam could have let you, the taxpayer, treat Mike as a qualifying child. That means you get all of the associated benefits, including child tax credit and earned income credit. And if you don't agree, so if you both try to claim Mike as a qualifying child, then the parent with the higher AGI is going to win that dispute.
Generally speaking, if they do agree in a situation of unmarried parents that don't file joint tax returns, can someone actually file a joint tax return if they're living together but not married?
No, you have to be married to file a joint return.
Okay. In that case, it usually makes sense whoever has the lower income has a better chance of qualifying and not getting on the downslope, right?
Yeah, it's possible, but what would usually be best is to just try both ways. So we have, let's see. Which means, so this is where it kind of helps to know the flow of a tax return, so you don't actually have to fill out an entire tax return. But to actually get the best benefit for this family altogether, we have to do 4 tax returns. So if mom might claim and doesn't claim, and then dad might claim Mike, or doesn't claim Mike. Okay, referring back to our example, mom had 12,000, dad had 14,000, so we're going to, so first of all we have to determine what their filing status is in each of these situations. Okay, so anybody who doesn't claim a dependent is going to file single. Oops. So it will be single in both of these columns. And if mom claims Mike, well, one of the requirements for head of household filing status is you have to pay more than half the bills. So it's likely that because Dad made a little bit more than Mom, he also paid a little bit more than half the bills. And it actually isn't going to turn out to matter, but Mom will probably have to file single if she's, even if she claims Mike. Whereas Dad, who probably does pay more than half the bills, can claim head of household.
So you'd wanna do it with Dad claiming Mike.
Well, we don't know yet. They get an extra benefit of getting head of household filing status, but we still don't know. So to do a tax return, we have to add up their income.
Because you're saying they can't claim, one of them can't claim head of household without claiming basically all the benefits.
Well, she can't claim head of household because, remember, head of household says that you pay more than half the cost of keeping up the home. So unless, because her income is lower than Dad's, it's likely, although it could be proven otherwise, but it's likely that she pays a little bit less than half.
I'm saying they can't split up like one gets head of household and the other gets some of the other benefits.
Right,
It's like all or nothing
exactly.
for whoever gets it.
Yep, so whatever benefits are available, you get, one parent gets them all or the other parent gets them all. The 8332 only applies in the case of divorced or separated parents, but they're still living together, so we can't use that 8332. So you might be tempted to say, well, let's give Dad, you know, the child tax credit and let Mom take the earned income credit. That would not be allowed. Okay. So next step would be income. So if we're doing these tax returns, it's going to be the same. So her income is going to be $12,000 either way. And Dad's income is going to be $14,000 either way. And then we're going to get our standard deduction. So I'm skipping the step where we do adjustments because we didn't know about any adjustments. Standard deduction is $12,950. For head of household, it's $14,700. Is that right?
19,400.
Oh, 19,400. And for single, it's $12,950.
Yeah.
Which means their taxable income is 0, 0, 0. But in this case, there's going to be 1,050 taxable income. Which means their tax is 0, 0, 0. What's the tax on 1,050? Does anybody have the tax table up? Single is $106. Okay, and then next we'll want to compute child tax credit, which is going to be 0 again for all these columns. But remember, the child tax credit is a non-refundable credit and you can reduce your tax to 0 but not below, so that child tax credit actually eliminates this tax. And now, so their net tax is 0 in every case. So next we just want to count additional child tax credit and earned income credit. Okay, does everybody remember the formula for additional child tax credit?
Leftover or 15% or something like that of your earned income? Or
Yeah,
max to
it's
1,500?
15% of the amount that your earned income exceeds $2,500. So subtract 2,500 first and multiply the result by 15%. Okay, so if Mom does not claim, Mom doesn't claim, then she's going to get no additional child tax credit. And if Dad doesn't claim, he'll get no additional child tax credit. So let's go ahead and put a line here so we can keep track of where we are. So if Mom claims Mike, take her earned income, so her leftover child tax credit is $2,000 because she didn't get to use any of it in this step. But also remember it's reduced to a maximum of $1,500 per child, so it's either going to be $1,500 is one possibility, or take this $12,000, subtract $2,500, we get $9,500, and then what's 15% of that?
$1,425.
Yep, sounds right to me. So she'll get 1,425 additional child tax credit. Now, in Dad's situation, this is going to be 14,000. Oh, no, I made a mistake here. If Dad does not claim the child, he has no child tax credit. So far, he's going to end up owing $106. But we don't know how the rest is going to pan out. But if he claims Mike, he has no child tax credit used on the top of his page 2. So 14,000 minus 2,500 is 11,500. What's 15% of that?
$1,725.
Okay, but remember it's still capped at 1,500 per child. So he gets 1,500 additional child tax credit. And now we get to look up their earned income credit. Because their AGI is the same as their earned income, we only have to look it up once. So for mom, single, one qualifying child, look up 12,000 in the chart, and we're going to get 3,733. But we can also look up 12,000 in the chart if she has no qualifying child, and she'll get 341 in earned income credit. Okay, if Dad claims Mike, we look up 14,000 in our earned income credit chart, and we get 3,733.
So it's non-refundable though, so.
Earned income credit is refundable.
Oh.
And if Dad doesn't claim, he still gets the earned income credit based on no qualifying children. And with 14,000, his earned income credit is 188. And in this case, he actually had some tax to pay. So his refund,
$82.
$82. Okay, now that we've done all those 4 tax returns, we have to match these up. So if mom claims Mike, so her refund total is this total of these two, which is 5,158. In this case, her refund is 341. And in this case, Dad's refund is 5,233. Okay. So if mom claims Mike, then she gets a refund of 5,158, which is this column, and Dad will get this column, so plus 82, and this is not counting withholding. The withholding is going to be the same in any of the 4 columns, so it's not going to make any net difference in the calculations. So 5,233 $240 to the whole household. And that's usually what we're aiming for, what people want to aim for, is the most money coming back, because it's all going to go to the same bills either way.
So really the difference becomes roughly the taxable difference on their income. That $2,000 difference in terms of what he earned versus she earned, and whatever that taxable value is really the only difference in the net.
No, because their tax is almost zero. This is the only case where there is any taxes, when dad is filing single without claiming any dependents. So really, it's almost impossible to predict this without actually doing the work. So if dad claims Mike, he gets a refund of $5,233. And mom will still get a refund of $341, for a net total to the home of $5,574. So in this particular case, this is the winning result. So, dad could let mom claim the child, but it's better off for both of them. It's better off overall to claim, for dad to claim the child. Of course, they might, their finances might be separate. They don't want to share this money, so they might both want to claim Mike. In that case, dad is going to win this because his adjusted gross income is higher. I would actually do this normally in an Excel spreadsheet, and this could take me less than a minute to do all this, especially if I've done this work, recently, repeatedly in the same tax season, instead of, doing it by hand. But this is basically, each column is a tax return. It's just not in the correct format to submit to the IRS.
Yeah, it's not a 1040, it's
Right.
freehand.
Right, but if you were to put this into your tax software and produce a 1040, these are the same numbers that would pop up.
If somebody owes child support and their taxes or tax return is garnished, then is that something that comes up, or?
It's not something that will come up in our system, so that's a good reason. Maybe dad owes child support from a previous relationship. So that might be a reason that we want mom to claim, or they want mom to claim the child, so that her refund doesn't get garnished, so he'll lose his $82 refund. But they'll still get that $5,000 for mom's tax refund. So even though they kind of lost out on $300, it's coming into the house instead of going out to pay back child support. So thank you, Mercedes, that was a good point. Okay, so there's our note. This is where we said that we can only split the tax benefits between two parents in the case of divorced and separated parents. So all tax benefits go with one parent. Okay, so let's try to work our way through this example. These EIC situations, these are very important because these will mirror a lot of what our clients will be going through or presenting to us as problems. Okay, so our taxpayer, our client is married, and they have a 10-year-old son, Joey, and they all live together until August 1st, 2022. So I'm just going to put these up real quick. Let's see. This is going to be you or residency test. Okay, Joey is 10 years old, so he's not filing a joint return, he's not married. Age test under 19, so we meet the requirements for both you and Bob, I guess his name is. Relationship, well, son for both. And residency, they live together more than half the year, so the residency test is met for both parents. So both parents could conceivably claim Bob as a qualifying child for earned income credit. So we have to continue reading. Bob moved out of the house, so, and then in August and September, Joey lived with you, and then for the rest of the year, Joey lived with Bob. Okay, so let's count the months. January through July is 7 months, plus 2 more, August and September, so this is going to be 9 months. And then January through July is 7 months, and then October, November, and December, Bob is going to have 10 months. So I feel a tiebreaker test coming up, and already know that Bob is going to win the tiebreaker test because of the number of nights rule.
So they don't even get into the AGI because the nights year rule trumps the AGI.
Right. Mm-hmm.
Yeah, you don't have to go that far down.
Yeah, so it doesn't matter what the relative AGIs are. But let's see. Joey is a qualifying child of both you and Bob because he met all 4 of these tests. He lived with you, each of you, more than half of the year. And at the end of the year, you and Bob are still not divorced, legally separated, or separated under a written separation agreement. So the special rule for divorced or separated parents does not apply, which means an 8332 will have no effect on this tax year. Which means one of the 2 parents has to claim all of the benefits. You can't split that up.
So they would basically just be married filing separately.
Mm-hmm.
Okay.
Right? Remember, the head of household rules, the special head of household rules, to be considered unmarried. Were that you and your spouse lived apart basically the last 6 months of the year, so from July through December. And that's not the case. They were still together on July 1st. So nobody gets to be head of household. So if they file married filing separately, remember also the special rule for married filing separately also says that you have to live apart for the last 6 months of the year. So if you and Bob choose not to file jointly, your filing status is married filing separately, and neither parent, no matter what, will get earned income credit. See, we're going to have 2 possible outcomes on the next 2 slides. If both of you want to claim Joey as a qualifying child, Bob wins that dispute because Joey lived with him for more nights than he lived with you. But he cannot claim the EIC. Bob may agree to let you claim Joey as a dependent because you do meet all the requirements and the parents can choose freely between them if they agree. So you still get, all the other benefits. You'll get possibly head of household filing status, you get child tax credit, additional child tax credit, but again, you cannot claim the EIC. So nobody's going to get the EIC in this case. The only way to get the EIC back is they would have to file a joint return. So we do have occasionally people, let's say, they're not talking, they can't stand aside of each other, but they may each bring their documents separately, and we'll file a joint return for them and have them come in and sign separately, and maybe even split up their refund. Or, that might be part of their divorce negotiations. It's like, we'll file a joint return and split the refund 50-50. Okay, and then I think the final thing that we're going to have, as far as the slideshow is concerned, is we're going to mention that if you file and claim earned income credit and you have any qualifying children, you have to fill out Schedule EIC. And it's a pretty simple schedule. It just lists, do we have an example? No. Schedule EIC just asks you, actually this. Go ahead and look it up.
Are any of the tax benefits for dependents void if someone had a baby in December and only had a baby for like a month before the new year starts?
No. No, remember, dependents, they count as living with you more than half the year if they lived with you more than half of the part of the year that they lived during 2022. So as long as they were alive at all during 2022, they count as your dependent.
So later part of the year is a great time to have a children to get more
Yeah,
benefits.
well, you start getting your benefits, your child-related tax benefits a year earlier, but they'll also go away a year earlier. Okay, so this is a schedule of the EIC, and it's fairly simple. There's columns for up to 3 children, and if you have more than 3 children, it doesn't matter. List any 3, because there's no earned income credit for 4 children or 5 children. It only goes 1, 2, or 3 or more. And it just asks you what the child's name is, what their social security number is, and what year they were born. And then it asks if they were born after 2003, this is 2022 tax returns. So in other words, they were under 19 at the end of the year, we'll actually skip these 2 questions and go on to this one. If they're born 2003 or earlier, they might be age 19 or older, and we have to answer these 2 questions. Are they under 24 and a full-time student, or were they permanently totally disabled? And then we just ask, what's the relationship and what's the number of months that child lived with you during 2022? There are 2 special instructions regarding this number, and over here on the left. It says, if the child lived with you for more than half of the year but less than 7 months. So if they lived with you 6 months plus 3 days, you might instinctively round that down to 6 months. But if it's more than half of the year, you actually want to round it up to 7 months. And if the child was born or died in 2022, then it says just put 12. So if a child was born in December, you might be tempted to say 1 month because they were born in December and they lived with you during December. But the special instructions say just put 12 months, even if you weren't even alive for 12 months.
Because they don't want to ask the question of whether they were alive or died, and so they just tell you to default to that one, right?
Right. Well, basically, the reason is if you put 3 months, then the computer is immediately going to say this child does not qualify, and it says you did your earning credit wrong. There's not going to be any human intervention to double check to make sure this number makes sense.
Mm-hmm.
So they want you to put 12, basically to bypass the computer check. Okay, and that's all Schedule EIC is, just to make sure that you are following the rules correctly. And let's see. Next, probably not mentioned in the slides, well, they should be later on, but also remember that the preparer has to prepare and file Form 8867, which is our due diligence checklist, which we were introduced to that last Friday. And in addition, if your EIC was denied or reduced in a prior year, you'll have to file this Form 8862. And you'll usually have to file that the first time you claim earned income credit after being denied. You might be denied or reduced earned income credit. For example, maybe you claimed a child that wasn't supposed to be claimed. Maybe you claimed your cousin's son or daughter and put niece or nephew when it turned out that that wasn't really the case. Or maybe you claimed earned income that you didn't really receive. I have had one client who did their own taxes one year and they got unemployment and they didn't know the difference between a 1099-G and a W-2, so they just put that in the same as they would have a W-2. And the software they were using claimed earned income credit based on that unemployment income, even though it's incorrect, because the software doesn't know that you're making a mistake. It's garbage in, garbage out. So IRS eliminated that EIC, and now to claim EIC, that person had to file 8862 the first year they claim earned income credit after that. 8862 is actually also fairly simple. It's basically similar to a scheduled EIC, except with a little more detail. Okay, so I just asked you what tax year you're filing this for, because they don't reprint or revise the 8062 every year. What credits are you claiming? So we would check the box for earned income credit, and then if the only reason your earned income credit was reduced or disallowed was because you misreported your earned income in a previous year, then you check yes and you're actually done with the form. But if you claimed an improper child, then you might select no here, and then it's actually going to go in more detail. Could you be claimed as a qualifying child of another taxpayer? No, you'll want to answer. If it's yes, you can't claim EIC. And then it's going to ask you to list the children. And instead of just asking how many months did they live with you, they'll ask specifically how many days during the year that child lived with you. And it has to be at least 183, which is more than half. Half of 365 is 182 and a half. And then it's going to actually ask their specific date of birth for children who were born or died during the year. And then how many days did you live in the U.S.? How many days did your spouse live in the U.S.? And basically that's it. And then child tax credit is going to ask similar questions about your children. And then for tiebreaker tests, it'll actually ask you, who else might be claiming that child, and it's going to ask you what actual address did you live with the children at?
So if we do the tax return with your guys' software, will it pop up and let us know if we have to do this form?
No.
No.
No, we have to actually ask them, have you ever had your earned income credit reduced or disallowed? They'll actually know it, they should know it for two reasons. One, they got less of a refund than they were expecting. Secondly, they probably got an audit notice, so they actually had to go through the audit procedure. And third, everybody who's in this situation will get a reminder letter saying you have to file 8862 next time you do a tax return. So it's not usually going to be a surprise for most people.
Okay.
Although, if you move frequently, the IRS always sends letters to your last known address, whatever the last address you used to file a tax return. So if you've moved since the last time you filed a tax return, you may even get audited and your EIC denied without you knowing, because the letters are all going to your old address. The best way around that is to make sure you update your address with the IRS. Okay, we're going to talk about errors and due diligence real quick. So the four most common mistakes people make when claiming earned income credit are claiming a child who's not a qualifying child, so claiming your best friend's kids, or claiming your significant other's kids that are not your own biological children. That's fairly frequent. And so we do have to be careful, not only when I said aunt and uncle. So aunt and uncle, we have to be careful because regular English speakers use these terms differently than the tax code uses them. So aunt and uncle, we have to double check, is that your brother's daughter, or well, not aunt and uncle, I meant to say niece and nephew.
For tax purposes, you're saying those are just
Yeah.
your direct siblings, descendant.
Right.
Or
So people may put, may list people on their data sheet, and they may say, I want to claim these children. And we encourage people, if you're not sure, list them, and then we can ask you questions about them, or you can ask questions about them yourself. Make sure you list everybody that you think you might be your dependent, even if you're not sure. Just make sure that that we have a full conversation about those children. So, but people will put niece or nephew on their relationship status with that child, and we have to double check, do you mean your brother or sister's daughter or your brother or sister's son? And we also have to be careful with stepson or stepdaughter.
why is that? I thought you said that before that those ones do count.
They do count, but people who are not married, who maybe lived together for the last 15 years or less, people who aren't married that live with their significant other's children might put stepson or stepdaughter. They think of them as their stepchildren.
Mm-hmm.
You've lived together for 8 years with your significant other's baby from a previous relationship, but that's not really for tax purposes. Because you're not married, that is not really your stepson or your stepdaughter. So our questions are, when they put niece or nephew, double check your brother or sister's son or daughter, and then, are you married?
But if they were married in the first half of the year, then they still count, right?
Mm-hmm.
Because you said those are considered in
These,
perpetuity.
right, these relationships do not expire with divorce or death of the spouse. So you could divorce your ex and have the stepchildren still living with you, and that would be your stepson or stepdaughter for tax purposes as well.
Is there situations where one parent could claim them as a qualifying child, but another parent can potentially claim them as a qualifying relative, like a double dip in a way like that? Does that ever exist?
No, you can't. You can only one person can claim anybody else as a dependent. So you can't have a qualified child of one person at the same time be a qualified relative of another person. And remember, the very first test for qualifying relative is not a qualifying child. So if someone's a qualifying child of another taxpayer, then they're not a qualifying relative for anybody. Also, remember this rule about taxpayer said if someone is not required to file a tax return and they in fact don't file a tax return, then they're not considered a taxpayer. So you could claim your boyfriend or girlfriend's children as dependents, but not as a qualifying child. They could be a qualifying relative, as long as your boyfriend or girlfriend income is under the standard deduction, $12,950. So if they only make $12,000 working and they don't file a tax return, they're not a taxpayer because they're not required to file a tax return. And then you can claim them as qualifying relatives. But because they're qualifying relatives, they're not a qualifying child, so they won't get you EIC, but they'll give you that $500 other dependent credit. Okay, our second most common error is if you're married, you incorrectly filed as single or head of household. Remember, if you're married filing separately, unless you meet this last 6-month rule, you simply don't get the earned income credit. And that can be a $7,000 swing in your refund. If you lose $7,000, you might be tempted to say, yeah, we haven't lived together, well, we're not going to file a return. I'll just, we're about to be divorced anyway. I'll just put single on my tax return. And that's not allowed. What that means is you're going to have to, if you want to get that earned income credit, you have to file a joint return. For our due diligence purposes, if somebody, if maybe they're a repeat customer and they filed married filing joint in 2022, and they come in and they want to file single this year, we can actually look up on Alaska Court View whether their divorce was final. But we would ask them, it's like, oh, it looks like, did you get divorced? They're like, they might say, well, we're planning to, get divorced, but we haven't really filed it yet. Then, oh, sorry, but you're going to be married filing separately, or head of household, depending on, this last 6-month rule. Third most common error is reporting the wrong amount of income. For example, the example I gave you of where somebody counted their unemployment and reported it on a W-2, or forgetting about the PFD, which is going to increase your AGI. And if you're on this down slope, if you're on this slope on the earned income chart, more AGI means less earned income credit. So if you forget about the PFD, then that could be considered under-reporting income. And Schedule C is coming up pretty soon. We're going to talk about business income. When EIC is involved, you can end up over-reporting income because you're not taking all of your deductions. And for that, for purposes of EIC, you are required to claim all the deductions you're entitled to. Because if you're on the upslope for earned income credit, and remember this is like 45% if you have 3 kids. If you increase your income by $1,000, your earned income credit goes up by $450. Your self-employment tax goes up by $140, and maybe your income tax goes up by another $100. So even though your tax bill goes up by $240, your credit goes up by $450. So you're still in the green by $230 by inflating your income. So this is a big temptation for people and for dubious tax preparers to invent income for people. There have been quite a bit of tax fraud related to this. If I just, if you come in and you say, well, I have no income, or I just have Social Security, survivor benefits from Social Security, you say, well, you have no income, you get no earned income credit. But if you were in business and made $10,000, you would get a $4,000 earned income credit, plus your child tax credit would take care of your regular tax liability. And your self-employment tax would be way less than your earned income credit. So if I put a fake Schedule C with $10,000 in business income, I just got you a $4,000 refund that you weren't entitled to. And that is a big temptation for a lot of people just doing their own tax return if they know these rules, just to put those numbers into like TurboTax or whatever. Or it's also a big temptation for people to come in and pretend to be business owners. They might say, I do some housekeeping on the side and I made exactly $15,000 and I spent $3,000 on supplies. And so what's my earned income credit going to be? So anytime we have earned income credit and self-employment income interacting, we have to be extra careful to make sure that we're reporting the correct amount of income and expenses.
So it's especially true for low income earners that may.
Yeah. Anybody who has net income under 50,000 or 60,000.
Wait, why is that? Under 50 or 60?
Because the phase out isn't complete until you have about 63,000. I think.
Because it seems like the only time that would actually be beneficial is when you're on the upslope, you might inflate it. But when you're plateaued or on the downslope, inflating it with false income wouldn't get you anywhere
That's true.
beneficial, right?
Mm-hmm. But people who are on the downslope would be in the opposite incentive. They might want to underreport their income. They might say, yeah, I drove for Uber and I made like $3,000, but I drove for 10,000 miles, so it's actually a net loss of $2,000 or $3,000. So that's going to reduce their earned income and reduce their AGI to get them more earned income credit. So we still have to do extra due diligence whenever we're talking about self-employment and earned income credit interacting together. Okay, and then the fourth most common error is incorrect Social Security numbers. I know that my parents know all of our Social Security numbers by heart, but a lot of parents don't know their kids' Social Security numbers by heart. But if there's an error in the Social Security number, like you mix up two numbers, usually the IRS computers will catch that. But the IRS e-file database only compares the first 4 letters of someone's last name with their Social Security number. So if you have Bob Jones, it only looks at the first 4 letters of the last name, and that person may be confused with Melissa Jones, his sister, because they have the same first 4 letters of the last name.
I've actually run into that problem. Me and my brother have almost identical social numbers, just the last 4 are flipped.
Mm-hmm. And that is something, unfortunately, that we've done in our office, is we've had a brother and sister, we've been doing their parents' taxes since they were kids. And then suddenly, one of them's 19 or 20 and we're doing their taxes, and it turns out, oops, we had your Social Security numbers backwards this whole time. And it actually created quite a bit of a problem that first year until we got it worked out.
So that could be no effect for like 10 or 15 years while they're kids and they're just dependents, but suddenly when they're taxpayers, then it becomes complex.
Right.
Okay.
And you might even type in the wrong Social Security number, like swap 2 digits or a typo, and it might just coincidentally be, this is a pretty common last name, so it might just by pure coincidence match the IRS database, and it's gone through. and then the IRS comes back and says, hey, you know, on our own information, we know that this kid that you claimed lives in a different state, so what's the deal there? And something like that would, you know, we explain what actually happened, you know, we put in the wrong social security number, but that's gonna, anytime a human has to get involved at the IRS, they're understaffed, and it's gonna take at least an extra 6 months to process that tax return. Okay, there's a worksheet. So there's a worksheet to fill out, and you actually do have to fill out the worksheet because that's one of the 4 specific due diligence requirements, but the computer will actually fill that out for you. And we'll skip some of these examples. This is our 5-page instruction manual for how to for determining, it's actually a checklist for determining whether you can claim EIC based on your kids or based on no kids. And there's our summary. So let's take a break for a few minutes. Okay, welcome back. During the break, Dimitri asked about like what we charge, and I did say that for people with dependents, especially if they get earned income credit, their tax prep fees are basically double what we would charge someone with no dependents. So a simple tax return, if you just have one W-2 and you're not claiming any dependents and you're single, that runs starting at $159. And then if you have, even if you only have one W-2 and you have 1 or more qualifying children, a simple EIC return starts at about $329. So it's more than double. It's because of this extra work we have to do, extra interview, and extra liability, potential liability risk. Okay. But I want to do a tax return. So we're going to have a married filing joint couple. They only have one W-2. They have no PFD. They have 3 qualifying children who are all under 17 years old. So they qualify for child tax credit and additional child tax credit. And there's no other income and no adjustment. So this is about as simple as you can get while still claiming EIC and qualifying kids.
What's the 1284?
And this is the information from their W-2. This is box 1, that's their taxable wages. Box 2 is their federal withholding. Obviously they're gonna have numbers in boxes 3, 4, 5, and 6, but those aren't gonna end up mattering. Okay, so instead of filling out a 1040, I just do this in kind of this tabular format we did before. So their income is going to be what?
25,678.
25,678, and they have no other income and no adjustment, so we can skip ahead to the standard deduction. So what's their standard deduction going to be?
25,900. No PFDs as if they just got to Alaska or something.
Yeah, so they might not have any PFDs. Actually, I would almost always ask if they marked they didn't get a PFD, double check. Why didn't you get a PFD? Did you forget to apply, or are you new to Alaska? Some people will say, well, you know, it was garnished. If it was garnished, it's still income to them. It just went to pay off some bill that they had. So double check. That's something to double check. But maybe this whole family is new to Alaska, so they didn't qualify for the PFD. Okay, so another thing, another tangent is, what if this couple wants to itemize deductions? They bring in their mortgage interest statement and all their medical bills and stuff.
Then you do the quick math to see if they're going to be within that threshold. Is it going to be worth it?
Mm-hmm. Any other opinions? That's one thing we would do just in general. But if we take their standard deduction away from their income, their taxable income is 0. And so you can't get a better result than that. You can't get less than zero taxable income. So even if they came in and their mortgage interest was 26,000, and their charitable contributions was another 10,000, and their property taxes were 5,000, it doesn't matter. Their itemized deductions can't help them. It can only bring their taxable income to zero, not below. So in this case, you know, even if they brought a 1098, brought a bunch of receipts for charity, I would say, you know, good for you bringing those in, but your taxable income is already zero and is not gonna help. Okay, so if their taxable income is zero, what's their tax going to be?
0.
Good guess. So their tax is zero. And so now we're gonna wanna compute their credits. So what credits are they gonna qualify for?
Child tax credit.
Okay, child tax credit.
But really just getting additional child tax credit, because that, they can't go past zero on that one.
Right, their child tax credit is gonna be zero because their tax is already zero. But they will qualify for additional child tax credit. Anything else?
Earned income credit.
Earned income credit? And maybe I didn't say this explicitly, but earned income credit is a refundable credit.
So they get,
Are they gonna, what about child dependent care credit? That's a credit we mentioned before.
could be, I mean, but it's given they only have one W-2, it's unlikely.
Yes, they only have one W-2, so that means, remember, to get child dependent care credit, both spouses have to have earned income. So they won't get it for that reason. And the second reason is child dependent care credit is a non-refundable credit and their tax is already zero. So the child dependent care credit is not gonna help either. Okay, let's talk about additional child tax credit. Does everybody wanna help me figure out what their additional child tax credit is?
3476 or 3477 is what I came up with.
3477? Can you walk me through how you got that?
I took 2,500 out of the income of 25, and then multiplied the answer by 2015.
Perfect, that's exactly how you're supposed to do that. And you have two other limitations. Is the unused child tax credit, which was $6,000, which is more than this, and the other limitation was $1,500 per qualifying child, which is $4,500. So this is the smallest out of those three numbers. So good job. So that is their additional child tax credit. And now, just assume we've done all the work of interviewing the taxpayers and making sure they're claiming the right dependents. What's their earned income credit going to be? That chart's actually both three, so if you can bring that, then Mercedes did, she'll do it for us.
Roughly 6,500.
68.
66.
I got 5,767. If I'm reading the chart correctly.
That seems a little low to me.
45%.
Okay, so
They're right on the cusp of a possible downturn.
so in your chart, so you're looking at 25,678, right? That one. And you go to the second set of numbers because it's where it's going currently.
Okay.
Oh, so they just get maxed out,
Yeah.
69.35, unless they're just past the downturn.
Yeah, it is 6,935. Okay, and well, what else do they have? Oh, they have withholding. So they're going to count that as a payment too. So how much is the refund gonna be?
11,696.
Yeah, yep, that sounds about right. And this is not even a very unusual tax return. We see, fairly regularly, we see $10,000 per refunds for, this is not a great income for a family of 3. I think this is technically below the poverty, or family of 5, I think it's technically below the poverty line. But we do see families, in this income range getting $11,000, $12,000 refunds. And our tax prep fee, so one thing, ethically, you're not allowed to base your tax prep fee on the refund. We do hear about tax preparers who will do something like, I'll take 10% of your refund as, a tax prep fee. That is completely forbidden. You're not allowed to charge a percentage of someone's refund as a tax prep fee. So our bill would say something like, your 1040 base charge is maybe $110, and your W-2 is another $15, and then each dependent might be another 40 times 3, another $120. And then we're going to charge for EIC, the 8867.
So essentially per page, practically.
Yeah, additional child tax credit. EIC and 8867, this is going to be about $100 each, and maybe another 100 for additional child tax credit.
You're in the tax preparation fees, and once they're itemizing,
Mhm.
they don't really matter to the person in terms of deducting, right?
Right. Well, if this person had a self-employment income, like a Schedule C, that might be another $180. This part, anything that's itemized out as a business-related tax prep fee, this is deductible as a business expense next time they do their taxes.
That portion.
Right, but all of this is all personal, and so that personal expense is not deductible as
So
a
that
business expense.
that lags. So they're deducting that in the next tax year.
Yeah.
Okay, but not in the current.
Yeah, because if we're doing their 2023 taxes, it's 2024 now already, and they'll deduct that on their 2024 tax return.
Because it was an expense occurred in 2024.
Right, because you get to deduct it when you actually pay it. So this might be $545 tax return. But it would, they do have some of the peace of mind of knowing that someone professional has done their tax return. And if they get audited, Eric or I will go to bat for them for no extra charge, and help them gather the information that they need to win that audit.
Which at that point you guys should have pretty much on hand anyway, right?
No, not necessarily, because the IRS is going to ask for things like prove your kids lived with you, and they're going to ask for school records, and letters from your doctors or your clergy or your social workers that say, yes, we believe that these kids lived with these adults.
But minus the stuff for like the kids living with them and stuff like that, all the tax information we would have on file.
Right, yeah, we would have a copy of their W-2, we would have a copy of our notes from our interview and things like that. But if the IRS wanted to audit this return, they would ask, well, if it's your children, there is a database somewhere where they can look up the relationship, whether they're your son or daughter. They're not going to worry about that. If it's someone who's not your son or daughter, the IRS is going to ask for birth certificates and enough birth certificates that you can prove that that's your brother's children or your sister's children. So to prove, like if one of these kids was your niece or nephew, you'd want your birth certificate, because that's going to have your parents' name on it, your brother's birth certificate, because it's going to have the same parent's name on it, proving that that's your brother, And then they're also gonna want the kid's birth certificate showing that your brother is their father.
So you need 3 birth certificates to claim a niece or nephew?
If you get audited.
If you get audited. So we don't ask for those up front. If they happen to bring them, great, we'll scan it, we'll have it on file. But we're not gonna make them bring it in. We're just gonna ask them the question, is that your brother's kid? And then to prove that they lived with the parents for more than 6 months, we're gonna want school records, childcare records, letters from somebody who's not part of their family. So a letter from your grandmother is not going to really help very much.
Letter from the teacher at work.
Yeah, letter from the teacher, letter from your landlord, people who are not directly involved with your family, saying, volunteering that they believe that your kids live with you.
How many audits a year do you guys go through roughly?
For earned income credit, we typically go through 1 to 3 audits per year. And then for all audits together, that's another 1 to 3, so anywhere from 2 to 6 audits per year. Which is a pretty good rate for the 3,000 tax returns we do per year. So that's, still less than 1%. And they may even audit your W-2. They might say, sometimes they'll say, we did get this W-2, but there is software that's publicly available where you can just file a W-2. It is fraudulent to file a fake W-2, but you can do it. So they may even ask for your pay stubs from that year. To make sure.
If someone made up a job for earned income credit or other credits and stuff like that.
Right. Yeah, I could. There's not really much preventing me other than, ethics and the fear of going to jail. But I could file a W-2 as Walmart, saying that I made $30,000 working at Walmart. As long as I know their EIN and my social security number, I can do that. And the IRS will have this fake W-2 in their records. Of course, if I get caught doing that,
Tax fraud.
yeah, that's probably at least 5 years in jail for me.
Minimum.
Yeah. Plus, I'll never do taxes again.
But if you get caught and you live in Alaska, you'll realistically get that knocked down to like 3 months.
No.
No, because it's a federal crime. The feds don't mess around.
The feds, they don't cut deals like the state does.
Well, that's good because
Yeah, if you get a 5-year federal prison sentence, you're going to serve at least 4 before you're eligible for parole.
I think it's like 4 years and 7 months.
Yeah.
It's only like
You get
5 days.
You get like 1 day of good time for every 2 days you serve.
Well, that's on the state level. The federal level is even worse. It's like 1 day of good time for 5 days or something.
Yeah.
that's good. They should make more crimes federal then. They pretty much broke the system here as it is.
Okay, so that is a fairly simple tax return with a huge refund. And, of course, we've done the extra work of doing 8067. We have promised to defend the tax return and audit if it gets audited. And working on an audit is at least 20 hours of work, and we don't charge any extra for that. So that, that $600 tax prep fee is going toward, even if you don't get audited, you're subsidizing the people who aren't getting audited. Okay.
When you guys do get audited, does a lot of that work end up on the office assistants and such to kind of just scan and send documents?
Yeah, it does. One of our corporate clients was recently audited, and they had 200 pages of documents. So we just scanned it all in, and then separated it out by chapter in the book that they brought us. But I had Don do that instead of doing it myself. Okay. So what I want to spend the rest of the class doing is to watch some of these IRS videos. So these are videos that are produced by the IRS to help preparers understand the EIC rules.
Spend enough time in this business, you think?
All right. So maybe as kind of an exercise to help like active watching, write down JARR on a blank piece of paper or something so that you can help determine, and then maybe an extra line for tiebreaker test in case that comes up, so that we can identify when during these tax interviews someone is eligible to claim the EIC.
You've seen it all. No surprises left. Then life slaps you with a reminder. Things aren't always as they seem. Joan, is that you?
Yes.
How are you?
Fine, how are you today?
Good, thanks for coming in.
Thank you.
What can we do for you today?
Okay, I have a 13-year-old niece named Ashley. She lives with me and my brother Ed, her dad. We share the house and we share the expenses of raising Ashley. Now, Ed and I talked about this and he said it's fine for me to claim Ashley on my taxes this year so that I can get the earned income tax credit.
Hold on a sec, Joan. Ah, there, that's better. Now, there are a few things I need to ask to determine if you're eligible.
Sure.
All right, so we've already, I answered some of the questions for, can she claim Ashley as a dependent?
Yes.
Joint return test. Ashley is only 13, so she's obviously not married, so she passes that test. Age test, is that passed?
She's only 13.
Right, she's under 19. Relationship?
Daughter.
No, not daughter.
Stepmother.
Niece.
Niece, yeah. And she already said that her brother is her dad. And residency test.
They live together.
Yep, they all live together. So, so far, but they also meet the same requirements for dad. So I think the tiebreaker test might be coming up pretty soon.
But she already said that he told her she can claim him, or she can claim the child.
Right, so the tiebreaker test, so when one parent, the parent can choose not to claim the child, but there is, remember, an AGI test. So I think I think the rest of this video is going to discuss the AGI test.
What is your age and what is your income?
I'm 35 and I make $27,000 a year.
And Ashley's dad, Ed, do you know what his income was this past year and what is his age?
Ed makes about $5,000. He only works part-time. And he's 50. He's my older brother.
And Ashley's mother?
Oh, she died in a car accident over a year ago. That's why I came and lived with Ashley and Ed.
Okay, that's a good point. You should always ask about any missing parents. So obviously the mother is not going to try to dispute this claim because she's deceased. But the mother might still be in the picture. If she were alive, you'd have to make sure that she didn't also live with the kid for more than 6 months because she would be first in the pecking order if she were. So maybe, but if she didn't live with them, then it's not a problem. But make sure you ask about any missing parents.
Okay, Joan, let me run down my checklist and do a little bit of calculating.
So how's it looking? Go get the EITC?
What do you think?
I think she's nervous.
Yeah, but do you think she's going to get the ITC?
So she's single, right, in this case?
Well, she would be
She's
head
not
household.
married. She probably head of household. Her income is quite a bit higher than her brother's. She said they share the bills, but she makes a lot more than her brother, so she probably pays the majority of the bills.
Either that or she's nervous because she's lying.
Yeah, maybe she's nervous because she's lying, yeah.
I would say that she's lying though, because there's no way that 5,000 is gonna cover half the bills, it doesn't even cover the rent for a year.
Mhm.
Maybe she's never sure we spent the money, she's really hoping that this covers it.
I would go with that she's giving fraudulent information.
Well,
But if the information was good, I would say she'd probably qualify for the IEC.
yeah. Yeah, so, like, we wouldn't actually need to ask what her income was, we would be looking at her W-2 and we'd know what her income was, but we wouldn't necessarily know what Ed's income was, because maybe he doesn't even file a tax return. So, we would have to base our judgment based on the best, information we can get from the client. But if these facts are correct, then
She would get it.
she would get it, because her adjusted gross income is more than Ed's adjusted gross income. So she is eligible to claim Ashley as a dependent. For EIC purposes, for head of household purposes, for child tax credit purposes, for everything.
And indeed, you and Ed both meet the age, relationship, and residency requirements. And since your income is higher, you and Ed can choose which of you wants to claim the EITC this year for Ashley.
Great. Woo. I was a little worried that I had to be her parent to qualify.
Not always, but John, it might be a different story had Ed made more than you.
But she can also claim Ed potentially being a sibling?
No, he makes too much for the dependent.
Ah, that's right.
Right, remember the gross income test says that his income would have had to be less than 4,400.
How old are you and what is your income?
Instant rate.
35, and I make $27,000 a year.
And Ed?
I'm not sure exactly. He works part-time. $5,000, I think. Not including the money market account.
Money market.
When his wife died, Ed put the money from the life insurance into an investment that pays him an income. $30,000 a year.
Okay, John, let me run through these numbers and do a little calculating.
Okay, now what?
No, it makes more than her, she doesn't get to claim a child.
Right. Mm-hmm. Yeah, so her adjusted gross income is less than Ed's adjusted gross income, so she cannot claim Ashley as a dependent.
Is that because
Even-
that counts more like interest income
Yeah.
than it does
This is gonna be like interest and dividends.
It goes to
insurance payout?
Yeah. So we're saying like he got like a $500,000 life insurance benefit, and he just put that into the money market, and he's getting $30,000 in interest per year.
So he probably wasn't taxed on that payout, but he's being taxed on the returns from that principal that he's got in the
Yes.
account now.
Yeah, exactly. He did not get taxed on the $500,000, but he is going to get taxed on interest and dividends.
If you come across a situation like this and Ed isn't in the vicinity to say yes, she can claim the child, do you have to get permission from him personally, or just take her at her word?
That is a good question, and usually we just take our client's word for it. And that might not be 100% the best way to go, but as long as this person seems honest, we usually take their word for it.
As long as we don't have a reason not to trust them.
Right.
If they wanted the next year to be able to maximize the benefit, then would it be appropriate to advise, if he takes out enough to get his income below yours, if he takes out enough principal out of the account, where his interest is no longer 30 but like 25?
Well, his total income would still have to be less than hers, so he'd have to reduce his interest income by 8,000,
or so.
and the earned income credit's not going to be worth more than that 8,000. So they're going to lose money overall if he reduces his income by 8,000.
Well, he's not able to, at that point, likely get the earned income credit anyway, because he's got mostly interest income,
Right.
and he's getting above the $10,000 investment income, right?
Right. So she gets no EIC because she can't claim any qualifying children, and her income's too high to claim the EIC based on 0 qualifying children. And he gets no EIC because, just like you said, his investment income is over the 10,000 threshold. So nobody's going to get earned income credit. Ed's still gonna be able to take the,
Child tax credit.
child tax credit, yeah,
Would Ed be able to take the house or head of household?
probably, cause he's probably contributing this whole 35,000 toward the bills. But that would be a question that we would have to ask, maybe Ed and Joan together, or just Ed, you know, is that interest are you just rolling that back into the account, or are you paying your share of the bills with that? So, head of household, question mark, because we don't know that he's spending that 30,000 on household bills or just saving it.
So if he's splitting that household expenses with her,
Yeah.
then that would be it. Okay, I guess I didn't think that would make a difference whether he spent it
Yeah,
or saved it in this case.
it's head of household goes to whoever pays more than half of the bills. So if he's just rolling that back into savings and letting Joan pay all the bills, he's not gonna be head of household. But if he's spending, and remember it's more than half, so if he's paying 51% of the household bills, then he'll be head of household. So head of household is questionable for him, her definitely not head of household, because remember you have to have a qualifying person to be head of household. So all good observations.
So how's it looking? Do I get the EITC?
This year, neither you nor Ed can claim the EITC. Since Ed has a higher income than you, the tiebreaker rules don't apply.
So only Ed could claim Ashley. But Ed makes too much investment income to qualify for EITC.
However, he does have some child benefits that he can claim on his return. As for you, Joan, I'm sorry. Just when you think you've seen it all, someone comes along and opens your eyes. Hello, Miss,
Cassidy. Sunshine Cassidy. I know I don't have an appointment, but I sensed by your aura that you would be free.
how can I help you?
Well, I want to know if I qualify for the EITC. See, I have 2 adopted dogs, 4 cats, 3 gerbils, a son, a daughter, and a foster child. All living with me.
Full house. Are you married?
Legally separated for 18 months now. When my husband moved out, he said I have issues with saying no. Anyway, with so many mouths to feed, I could really use a little extra money.
Interesting. Can I interest you in a seat?
I am seated.
Excellent. Do you have employment income?
Yes, 39,000 last year.
Any other income? Home business, part-time job, interest?
Just interest. $500.
How old are you and your children?
Son 13, daughter 11. And according to the Mayan calendar, I'm 40.
Does your husband provide financial support for the kids or claim them on his taxes?
You filed joint or separate returns?
No support. He's unemployed. I filed head of household, and my husband does not claim the children.
And your foster child?
He's 19. He goes to a local community college full time.
Do you have a court order for him to live with you?
Yes.
And did your children and foster child live with you more than 6 months of last year?
Entirely with me. As does my brother. He's permanently disabled. And his stepdaughter, she's 10. And my parents. It's a little crowded, but you can't say no to family, right?
Do your parents provide support for the family?
A little for groceries. And my brother gets a small social security check. I pay the rent, the utilities, pretty much everything.
Where's the mother of your brother's stepdaughter?
She travels on business. She and my brother are divorced, and he loves the kids, so...
I know. It's hard to say no. From what you said, you may qualify to claim the EITC for your son, daughter, foster child, and brother, but not for your parents or your brother's stepdaughter.
And the pets?
Seriously? No.
Well, at least there's some help on the way.
Oh, you're not there yet. Make an appointment with me or another qualified tax preparer. And read publication 4717 to become familiar with the questions that we by law must ask you, as well as the documentation you must provide to verify your status as head of household and to claim tax deductions and credits, including the EITC.
Well, I can't say no to that. I'll be giving you a call. And thank you from all of us.
All right, any questions or comments about that one?
Interesting. From the beginning, you smelled BS, and then all the due diligence uncovers additional possible qualifying children and relatives.
Mm-hmm. Yeah, her brother is actually, interestingly, it's her qualifying child because he's permanently and totally disabled. He didn't ask whether everybody can be claimed as a dependent because these videos are about earning income credit. So her parents might also be her dependents, depending on what kind of income they have. If they're retired and they're getting a pension, probably their income is too high to be claimed as dependents, over 4,400. But if their only income is like Social Security, for example, they might be her dependents, depending on whether she provides more than half of their support.
I forget, the age requirement for the EIC, is it the same as for dependents in general?
Yes. Mm-hmm.
Okay. Because in this case, they counted all three of her children, and they checkmarked the permanent disabled brother.
Mm-hmm.
But ultimately, that was one of those isn't going to be of any benefit because she maxes out at 3 anyway.
Right.
For that one, right?
Right. The fourth qualifying child doesn't add any new earned income credit.
But it does for the other credits.
Right. So her brother, who's a qualifying child, is still 17 or older, so it's going to be other dependent credit for him, or if we're talking about child tax credit versus other dependent credit. Let's see, her son and daughter were both under 17, so they would get child tax credit. And then the other dependents, her foster child, even though he is her qualifying child, he's still over 17, so she's gonna get other dependent credit for the foster child, for the brother, possibly for the parents, and then her brother's stepdaughter. I'm not sure exactly why they said she didn't qualify as a dependent, but I guess it's because it's not really going to be her niece or nephew because it's not her brother's child.
But I mean, just quick math. What she was describing sounded like very possibly a $15,000 to $18,000 refund.
Mm-hmm.
Is that about right?
Yeah, we could try to figure that out real quick. So,
You don't have to if it's a distraction. I'm just like ballparking my math, like the math in my head. Like it's a lot of.
yeah, so she said her income was 37,000, and
500 for interest.
and 500 for interest. So this is W-2 and this is interest. So her total income is 37,500. Her standard deduction is, what was it, 19?
19,000.
She's on the down slim.
19,400.
Yeah, 19,400. So her taxable income is 18,100. So her tax based on 18,100 is, head of household is 1,882.
Which the rate non-refundable credits will easily take care of.
So let's quickly add up her child tax credit. So for the two younger children, that's 2,000 each, and her other dependent credit. Let's say her parents don't qualify, maybe they have a pension, so they can't. Their gross income is too high. But
The foster kid and her brother.
yeah, foster kid and her brother. So that's $5,000. So that's 1,882 for child tax credit and other dependent credit. So the unused part is 3,118, but this is limited to 1,500 per qualifying child. So she has a $3,000 limit on her additional child tax credit. And then we do the same thing where we subtract 2,500 from her earned income, multiplied by 15%.
But her foster child is technically a student, so when he technically qualify as a qualifying child?
Yes, he is a qualifying child. He's a qualifying child, but he does not qualify for child tax credit. Child tax credit, remember, is for qualifying children under 17.
So wouldn't the limit be?
No, it's 3,000 for each qualifying child for the child tax credit.
Okay.
So even though her brother and her foster child are both qualifying children under the rules for dependents, they're not qualifying children for child tax credit.
So that would be 5,175.
$5,175. Okay, so her net tax after credits is 0. So now her refundable credits is 5,000. Well, 5,175 is more than the 3,000 limit. So she's going to get that 3,000.
Additional child tax credit, right?
Mm-hmm.
And then whatever the EIC chart says for 3.
For three. She has 4 qualifying children for earned income credit.
So, but that's on the down slope, so you kind of. But that's.
So remember, child tax credit is ages 0 to 16, but EIC is ages 0 to
24.
18, 0 to 24, or any age if disabled. This is for people who aren't students, if you are a student, or if you're disabled. So, Mercedes, did you look that up?
Yeah, would that be just the 3,700, or would you add the 500 to it?
Well, remember her AGI is more than because her AGI is more than her earned income, you have to look them both up and choose the smaller number.
So 37,000 gives us 3 qualifying children. 3,376 based on her earned income. And then if we go up to 37,500, we get 3,271 based on her AGI. So we take the smaller one. And so, plus whatever her withholding was. So she's gonna get a refund of 6,271 in addition to getting all of her withholding back. So not quite a $10,000 refund, but still pretty high.
Have you ever had an eccentric customer like that?
No.
I don't know if I could have handled them putting their shoes on.
No, I would have been
I
like,
would've
get
been
those
like,
shoes
no.
off my desk, what the heck are you doing? I think a lot of, well, not us, but there are a lot of tax preparers who are appointment only, so you probably, so some people would have been like, what are you doing here? So you don't have an appointment. Talk to my receptionist. How'd you get past my receptionist? I think.
I honestly would have assumed she was on something.
All right, so yeah, let's do one more and then we'll break for the day. Actually, let me tell you where this website is. I don't expect you to want to watch any more of these videos, but if you do, there's also more due diligence training available for just for EIC. It's at eitc.irs.gov. And then there's a section on that you can see right here.
What was it again?
eitc.irs.gov, and there's a one tab right here is just tax preparer toolkit.
Who knew this could happen to a guy like me? I mean, they aren't even my kids, but I'm paying for them. If this doesn't work, I may have to hog my ride.
Mr. Kimball, been expecting you. Have a seat.
I'll cut to the chase. I'm looking for money. Any kind of money. You can give me back on my taxes.
Well, let's walk through some questions to see if you can qualify for the earned income tax credit. Tell me about yourself, Mr. Kimball.
Okay, well, I'm 25, I'm single, I make $12,000 a year fixing bikes. I live to ride.
And when you called, you said something about children at home?
My sister's kids. Eugene, named after me. He's 5. Hannah, she's 4. They've been living with me since last April.
And did the kids live with any other family member for more than half the year last year?
My sister and my mom, we all live in the same house together with the kids.
How much did your sister make last year?
Hey, I thought you were working for me. What's with all these nosy questions?
Calm down, Mr. Kimball. Standard procedure, nothing personal. I'm required by law to meet certain due diligence requirements. You did get the brochure I sent you in the mail? The IRS can penalize me if I don't ask, so.
Okay. I guess you gotta give a little to get a little.
Okay, where are we at so far? Joint return?
No.
Yep.
Possible head of household.
Yep. Well, joint return test means the kids are not filing a joint return. So they're 5 and 4, they're not married, so no joint return. So that's passed. Age test?
Yes.
Yes.
Yes. Relationship test?
Yes.
Sisters, kids, good. And residency test?
Yes.
Yes.
Yes, they lived with him since April, so that's more than 6 months.
So is this assuming this is like March, April timeline then? Of
Yeah,
1
well,
year, and
since-
you're talking about
yeah.
the last,
Yeah, it's always based on the calendar year. So April through December is more than 6 months.
I guess from the video standpoint, you don't know what timeline the videos would be taking place, and you can
Before
assume,
April 15th of the following year.
assume spring of the next year.
Well, when somebody says last April, that is usually taken to mean from the previous year's April.
Not this April, 2 weeks ago kind of thing. Okay.
Okay, so, yeah, so meets all those tests, and so does the sister, and so does the mom. So what do you think we're gonna be talking about next?
AGI.
AGI, yeah.
I don't exactly know how much my sister makes, but she said it was okay to claim the kids.
Do you know if she made more or less than you?
More. What difference does it make?
It matters because the law regarding who can claim the child changed the last few years. Now, the parent, in this case your sister, could claim the children for EITC, but another adult who's not a parent wants to claim the kids, and your income must be higher than your sister's.
Wait. I think I make more than she does.
Oh, now he's lying. I think he's lying, or doesn't know the facts. So in this case, I would still work with him.
I just require that he brings in W-2s.
Yeah, bring his income, bring her income, so I can verify that. Because maybe he's misinterpreting the facts, or but that's usually an easier way to get rid of people too. Is instead of just saying, "Oh, you're lying, get out of my office," bring me this document that we know doesn't exist, or bring me your sister's W-2 to make sure, and then you say, "Oh, it's right there in black and white. You can't do it."
And in those cases, usually the W-2 would be sufficient. You're not having to inquire about the siblings' additional other incomes, right? If no matter what, the W-2 is already above what he makes.
Right. Right. We don't need all of her information if we can already confirm that just by itself the W-2 is more income than his. Another thing, I don't think you're going to mention it in the video, but if he's fixes bikes for a living, he might be a self-employed mechanic, and that's a whole separate ball of worms. So I don't think that's actually going to be mentioned in the video, but that's going to add a lot of work on our end to make sure that we're doing his taxes correctly.
In this case, they're just assuming he chooses not to work much at all.
Yeah. Maybe he's a W-2 mechanic, or he works in someone else's bike shop.
Kimball, I'd advise you check with her and make sure. If you claim the credit in error, you could be audited. That means you have to pay back the money with interest and maybe some penalties.
Great, figures mom.
The penalty for making an incorrect EIC claim, it used to be that there wasn't a penalty, but now, more recently, since 2018, there's a 20% penalty. So if he claimed $5,000 EIC, and based on his earned income, he could get another 15% of 9,500, so another $1,400 in additional child tax credit. He could get a $7,000 refund. If the IRS decides that he didn't qualify for the earned income credit because of this AGI rule or for some other reason, not only does he have to pay the $7,000 back plus interest, he has to pay an extra $1,400 back. So, and then we might be also dinged for another $580 penalty, $560, $580, $500 plus inflation. And so would you. So that'd be like the IRS would collect an extra $2,000 from the three of us.
Mike,
What?
I'll call her.
No, wait. Also ask her if she plans to claim the children for EITC.
So in that case, because he changed his mind partway through the thing, that would be an example of inconsistent information. So then I would really want documentation here. So I don't think this phone call would be adequate.
I wouldn't trust it.
Hey sis, hey, I'm over here getting my taxes done. Need to know how much income you made last year. What up? Go ahead.
Almost $11,000.
And are you sure you're cool with me claiming the kids for the EITC?
Yeah, go ahead.
Just go online and check using the EITC assistant. Then we'll finish the paperwork and talk about your filing status.
Yeah, I wouldn't let the client call either. We don't know if that's really his sister that he just
I wouldn't
called.
remember that, I don't know my office either.
I would say, I would call her or, ask to have a separate appointment with her as well, so that, she might say, I said that, but maybe I don't really want him to claim the kid, or, if they were separated and we were talking to them separately, maybe she'd have something different to say.
Okay, numbers man, whatever you say.
I'm sorry?
Nothing.
They missed something else, so I don't like to criticize the IRS, but I will in this case. Wasn't there somebody else in that house?
His mom.
His mom. What's her AGI? Remember, only the person with the highest AGI out of everybody could qualify to claim that child. So even if her sister was okay with, even if all the facts we got were accurate, she made 11,000, he made 12, and she's okay with him claiming the child, we still need to know what was mom's AGI. Maybe she made 60,000, and then he's completely out of the picture. He doesn't have the highest AGI anymore.
Or she made 4,000 and it's the same.
Yeah, maybe she's disabled. Maybe she's retired. So we still need to know about the mom's AGI. So. So I give the IRS a D+ on this video because they left out the mom stuff, and they kind of let the client change his mind mid-interview without any good follow-up. So.
So how often would you actually ask them for their other person's AGI, or would you more specifically ask them, I need to know, like, their income streams?
Yeah, I always try to avoid using technical tax jargon, so I would almost never say AGI or ask them. It's like, I would just ask, what does your sister make? What kind of income does she have? Does she work? Does she have any other income besides work, the PFD?
Would you generally ask about retirement savings right away, if that affects the AGI?
Yeah. Does she get Social Security? Is she retired? Is her mom retired? What kind of income? Because, I would explain part of the reason I'm asking this is because, if the parent doesn't want to claim a child, then only the person with the highest adjusted gross income can claim them. So then I have to ask you about your income and everybody else in the household's income. And if it's rough figures, but the numbers are, far enough apart, I'm not going to need to see people's W-2s necessarily. So if he says, oh, my mom has a small pension and it's $6,000 a year, I'm not going to say, oh, well, I need to see her 1099-R to confirm that, because it's far enough apart. But if he's like, my sister made about 12,000, I made about 12,000, my mom has a pension that's about 12,000, then it's all close to each other. Then we want to see maybe some income documents for all of them. Or we might encourage them all to come together and we'll do all their taxes at once and figure out, once and for all, who should be claiming the child for the best benefit of the family and while still following the laws.
These non-married but related parties, if you can get them to come in together and they're open to sharing their info, it kind of removes that veil of secrecy that you have to, or privacy that you have to kind of have.
Yeah, so if they're sitting together at the same time, doing their taxes at the same time, they have waived confidentiality. So I can say, oh, this is your taxes, and this is your taxes, and this is what would happen if you claim the kid, and this is what would happen if you claim the kid. And we don't have that as much of the responsibility of confidentiality if they're sitting together. But if they came in separate appointments,
You have to keep the
without,
information separate.
yeah. Normally, technically, we're required to maintain confidentiality and only reveal information other than what shows up on the tax return, because your spouse's name is gonna be on your tax return, if you're married filing separately, for example. But we can't share tax return information with anybody without that person's written permission.
But you
Which-
can give it to that person, they can show the person next to them, that's not your problem anymore.
Right, so, and and that is, we can get in a lot of trouble for breaking that confidentiality. So like if someone calls up and say, hey, I need you to send my taxes to my mortgage lender. And I say, well, I can send you your taxes, and whatever you do with it after that is your business, but I'm not gonna send it to your mortgage lender unless you send me written permission, which could be just an email. They could email me and say, hey, please send my taxes to this guy.
Or an ROI.
Release of information, which they would have signed. So I could say, oh, yeah, give me your mortgage lender's fax number or phone number and tell them to send me the release of information first. But it has to be written permission, so you can't just call up. I had a phone call, it was several years ago, but it was a local used car dealer that said, hey, I need so-and-so's tax stuff, because we're gonna close on this vehicle, and he's getting a super sweet interest rate. And I'm like, well, okay, well, put him on the phone, well, give me your fax number so I can send you the release, and put him on the phone so I can make sure I'm talking to the right person. And then, like, the guy said, oh, come on, why are you being such a hard ass? Why are you holding up this deal? I'm like, it's not me, man. If I send someone's tax information that they didn't give me written permission, I'm kicked out of the industry. So.
We also had a lady last year who called like 4 times to get her taxes sent to her place in Lower 48. And it was her daughter calling for her because she didn't speak English. And that's where the problem came in.